We'll be going over the IRS Interactive Tax Assistant tool that helps taxpayers determine whether or not their mortgage-related expenses are tax deductible. So this would include mortgage interest, points, mortgage insurance premiums, and other mortgage-related expenses. To complete this tax assistant tool, you're going to need some basic information about your tax situation to include how much your income is, yours and your spouse's tax filing status, and an estimated total, if applicable, of the amounts that you paid for mortgage insurance or mortgage interest, mortgage points, and or mortgage insurance premiums that were reported to you on IRS Form 1098. So this tax tool is designed for U.S. citizens or resident aliens. If you are a non-resident or a dual status alien, you will probably not be able to use this tool, and you're going to have to see the international taxpayers section to get more information about your specific situation. So the tax assistant says that it should take about 12 minutes to complete. And please keep in mind, this is not official tax advice. This is simply a tool that the IRS uses or has put together for taxpayers to use to estimate whether or not their mortgage expenses are tax deductible. For specific written advice, you should always see a tax professional. With that said, let's begin. So we're going to go through a series of questions for either the 2020, 2021, or the 2022 tax year. While we're still at the end of 2023, the tax assistant tool is not ready for 2023. However, this can help you still kind of understand whether or not your mortgage related expenses would be deductible simply by understanding the types of questions that you would have to answer. So the first question, which tax year? We're going to use the most recent one that we can use, 2022. So for business use, was any portion of your home used for business purposes during the tax year? So if you did use your home for business purposes, then you would probably, you would have to use a different part of the tax code to claim a deduction for business related use of your home. We'll put a link to the article and the video that we've created about home related business use in the notes to this video. So for this purpose, let's just say no. Was the home used for rental purposes? Again, if this was a rental related expense, your mortgage would be would be deductible possibly on Schedule E instead of Schedule A. So let's say no. Let's kind of keep this within the itemized deductions section. So again, now we're on Schedule A. Are we itemizing deductions? As a reminder, anytime you hit the blue button, it gives you a little bit more of an explanation. So if you're curious as to what itemized deductions are, the IRS tells you that you may benefit from itemizing deductions on Schedule A if you don't qualify for the standard deduction, if the amount of your standard deduction is limited, if you had significant uninsured, like out-of-pocket medical or dental expenses, paid interest and taxes on your home, had large uninsured casualty or theft losses, made large charitable contributions, or if you had total itemized deductions that exceed the standard deduction. So we cover each of those actually in a playlist on Schedule A. We'll put a link to that in the show notes. So that's just the explanation of what you may consider when you're thinking about itemizing your deductions. So let's say that for this purpose, we're not itemizing deductions. So in this case, Because you're not using your home for either business or rental use, you would only be able to deduct home mortgage interest as an itemized deduction. So if you're not going to use Schedule C, Schedule E, or Schedule A to report your home mortgage interest, there is no other place for you to be able to report it. Let's go back and change the answer to that question. So let's say yes. So now it's going to ask what your tax filing status is. And again, this basically kind of helps determine. So let's say married filing jointly. Did you or your spouse have an ownership interest in the home that secures the debt? In other words, do you own the home that you have the mortgage on? So yes. Which home secures the loan on the home? So is it your primary mortgage? Is it a secondary mortgage? Is it another vacation home? Let's just say that it's your main home. And then what type of mortgage related expense are you talking about? Are you talking about mortgage interest, points, or insurance premiums? Let's say that we're talking about mortgage interest. Did you pay mortgage interest on the home during the tax year? So you can only deduct mortgage interest in the year that it was paid. So you can't, and you can't prepay mortgage on a future tax year and then claim it for the current year's taxes. So that's why you receive the Form 1098, because you're going to report the mortgage interest that you paid that was reported to you by the mortgage company, and the mortgage company is only going to report the interest that you paid during that year. Do you have mortgages originally taken out on or before October 13th, 1987? So that's kind of an interesting question. Let's take a look to see what that note is. So if you took out a mortgage before October 14th, 1987, or if you've refinanced it, it may qualify as grandfathered debt. So you can find more information in IRS publication 936. Of course, most mortgages that were taken out before 1987 are probably paid off at this point. So how did you use the proceeds from all of your mortgage taken out? So you have to have used the proceeds to buy, build, or improve the home, generally speaking. Was it taken out on or before December 15th, 2017? Were the mortgage loan balances $1 million or less at all times during the tax year? And the Tax Cuts and Jobs Act put a ceiling on the amount of home acquisition debt. So your total mortgages can't be more than $1 million. So did you have any of the following situations? Late payment charges, prepayment penalties, interest paid on your home that you sold? So we'll just say no, no, no. We're just looking at straight up mortgage interest that we paid. And then did you pay it to a financial institution, or was this seller financed? Did you receive a Form 1098? Was there more than one borrower liable for the mortgage other than you and your spouse? Because I believe if there's more than one borrower, then you kind of need to prorate the amount of interest that you're taking out on this. So if you and at least one other person were liable for and paid interest on a mortgage that was for your home, then you would only be able to pay a prorated amount. Let's just say that the answer to that is no. In this case, you can deduct your mortgage interest on the home. You would deduct it in the interest you paid section of Schedule A, and you would attach Schedule A to your tax return. You would report the amount of deductible mortgage interest that was shown on your 1098 on the home mortgage interest and points reported to you on Form 1098Y. So one thing that I always advise people to do is if you do use this tax assistant tool, you should take the time to print this out and then go over this with a fine-tooth comb just to make sure you didn't miss any questions. You're not, well, the federal government does expect you to be familiar with the tax law. So you need to be very sure that at the very least you're answering these questions to the best of your ability and that each of these answers is truthful. So if you make a mistake in here and you take the time to look at it, it's always better for you to catch that mistake than it is for an IRS examiner to catch that same mistake. However, having this printed will allow you to have a conversation with the examiner, and there is a difference that can be taken into consideration between a simple mistake where you're more likely to receive just a recalculation and a notice of the tax bill that you would have to pay plus interest, as opposed to being assessed a negligence penalty or more extreme versions of that. So basically, the IRS can make a determination that if you didn't exercise due diligence, if you were negligent in filing your tax return, you can be subject to additional penalties. So even if you make a mistake, you're still going to be held accountable, but it's better to be held accountable for an honest mistake that you made that you can fix on the spot than it would be to just have little to no documentation and just kind of fly by the seat of your pants and hope that they take pity on you. They won't. So print this out, go over it. If you made a mistake, go back through the tax tool again. And once you are satisfied that your answers are correct, then keep this in your own personal tax records. You don't need to file this with your tax return, but this is always a good thing to do if you're going to make sure that if you're going to file your own taxes and not work with a tax professional, it's always good to make sure that you have as much documentation that you can go over with an examiner for. I'm not going to go through every single scenario, but there is one interesting scenario that I would like to explore. We're going to change this from a financial institution to seller financed home. So a seller financed home might be something like if you were renting to own a home, you entered into an arrangement where you rented a home for a couple of years, and then at the end of that, you had an option to buy the home. So this is something that isn't, you won't find many articles in Forbes magazine about it, but this does happen from time to time for people that are looking for a starter home that can't quite get into it, but they like the home. They're going to rent it for a couple of years. And then over that period of time, maybe they experience a couple of promotions that help put them into a better situation where they can then buy the home. So let's see what happens if we select this one. So if you received a Form 1098, from like an established business, then you would probably report it the same way. Let's imagine you didn't receive a Form 1098. What do? So you can still deduct the mortgage interest, but the instructions are a little bit different. It says because you paid home mortgage interest to an individual, you're going to list that person's name, address, and taxpayer identification number on the dotted lines next to the interest not reported line. So on Schedule A, there's a separate line. Instead of interest reported on Form 1098, it would state interest not reported, and you would indicate that information. That way, the IRS can then backtrack that with the information that that person's reporting as income. So that's how you would report your mortgage related expense if you're in a seller financing situation. So There are a lot of scenarios that are covered in this tax tool. Feel free to kind of bounce around and check them out. But we will post links to videos that actually cover how to report mortgage related expenses as well as other expenses on Schedule A. We'll put those in the show notes because we do actually cover the reporting requirement for Schedule A and all of the subsections in that. So if you like our YouTube videos and our tutorials, please subscribe to our YouTube channel. We also cover Schedule A in an article that we've written. You can find that on our website. Simply go to teachmepersonalfinance.com, type in IRS Schedule A, and you'll see the article that we've written. If you like our articles, please subscribe to our newsletter. And if you like our YouTube videos, please subscribe to our channel. And as always, if there's a question, a comment, or if there's a tax topic that you would like for me to cover in a future video, don't hesitate to ask. Thank you very much and have a great day.